Well, thank you very much. Thank you for having me here. It's really a pleasure to be here to talk about this paper. I have a funny title. What does it mean? What I'm trying to emphasize and what I want to discuss over the next 30 minutes with you is that central banks have historically had a somewhat ambiguous attitude towards long-term interest rates. People, for instance, remember very well Milton Friedman's presidential address's point on how a central bank that would target an unemployment rate that was inconsistent with a natural rate would lead to ever accelerating inflation, either up or down. But actually, Friedman spends as much time talking about how a central bank that targets a long-term interest rate that is different from what will be some natural level will likewise lead to an accelerating inflation or not. At the same time, central banks, and this has been especially true in the last few years, talk about long-term interest rates a lot. Not as strict targets, but certainly in terms of intermediate targets or at least diagnosis of the effectiveness of those policies. In the slide I decide to pick on the Fed, and Janet Yellen, in describing in a recent long speech on whether unconventional monetary policies were successful or not, right away, and she's representative of what the debate among central bankers has been in the last few years, there's enough of them in the room here, hopefully, to agree with me, that one discusses right away that when one talks about asset purchases, forward guidance, or whatnot, the first instinct is to say, well, they were successful because they affected long-term interest rates. As if affecting long-term interest rates in a certain direction was a measure of success of policy. Now, central banks today have not embraced, have certainly been very averse to discussing interest rates, long-term interest rates, either as direct tools or as direct objectives. But that was not the case in the past. Again, sticking with the Federal Reserve, of course, the Federal Reserve Act, people refer to the Fed as having a dual mandate of stabilizing inflation and employment. But they forget that that dual mandate is actually only 60 years old. I'll talk about actually when it emerged. But for the first 40 years of its operation, the Fed had a tripartite mandate that included employment, stable prices, and directly a target for long-term interest rates. And actually, the act has never been revised. So the Fed just conveniently forgets about the third part, and this has been doing so for 60 years. Likewise, as tools, note right away, I want to make right away the observation that while we're used to central banks targeting an overnight rate, and how do they do so? By accepting deposits and paying a certain interest overnight, or by making loans through a lending facility that again would be close to overnight, and if not overnight, like in the case of the ECB, 1 week. The fact is that given a yield curve, and all I put here is the plot of the yield curve for the US just a week ago when I wrote the slides, there's no reason why the central bank can say, I will accept deposits of 6-month maturity, I will make loans through a discount window of a 6-month maturity, and in doing so put a floor and a ceiling and therefore have a target for the 6-month rate, or the 2-year rate, or the 10-year rate. In principle, it can be done through essentially the same, that is a long-term interest rate, can be a tool. So given this, what will this paper do? The main part of this paper is really to discuss 3 historical episodes, to go back in time, and to look at 3 cases where long-term interest rates were either a goal, but especially a tool for monetary policy, a direct tool for monetary policy, where central banks devoted themselves not to the overnight rate, but to the 5-year rate or to the 10-year rate. And discuss what happened then. Did that work well? Did that not? And again, while these are extreme, and I think it's not on the table today that any central bank would do this today, the fact that we spend so much time talking about what do our policies do to long-term interest rate does put us on a path that goes towards these historical episodes. And so it is useful to use the data that we do have to understand what happened in those experiences. To do so, though, before getting there, I'm going to do a detour. We'll take 5 or 10 minutes of this talk, and which is perhaps of less applied interest, but perhaps also of slightly more methodological interest, which is I'm going to recast the standard problem of inflation determination, by which I mean the standard Taylor, Woodford, Svensson, if you want, inspired problem of how is it that a feedback interest rate rule can control inflation. I'm going to recast this in continuous time using Brownian motions for uncertainty. Surprisingly, this had not been done before. The reason for doing this is that I'm going to show you that actually one can do this relatively elegantly. And second, it then opens up, and this is why it's done in this paper, it opens up the ability to integrate the models of endogenous inflation determination, if you want monetary economics models, with the very well-developed field of yield curve and affine, especially it's going to be affine models of the yield curve field in finance, which has grown in an enormous amount, both theoretically as well as empirically, and thus link exactly monetary policy, long-term interest rates in a very easy way, but which I hope will be useful for also further researchers that follow. So let me start with that. Let me start just with a model. This first slide, just want to tell you, this should be very familiar for those of you who have had to suffer through new Keynesian economics. There's a representative agent that maximizes expected discounted utility and who likes to eat but doesn't like to work. Overall consumption, though, is an aggregator of varieties of consumptions using a Dixit-Stiglitz formulation, where the 1 over 1 minus mu is the elastic substitution. And the household, this representative household, receives wages and dividends and consumes, and on top of that invests in assets. In this case, I have here two assets, bonds and reserves, but if you want, ignore the reserves for now. There's then a continuum of monopolistic firms that operate a linear technology with aggregate productivity A, and there's no capital accumulation such that market clearing implies that consumption is equal to production in every period and that the labor supplied by the household is equal to the labor employed by the firms. Finally, there's no outside assets in the economy. This is the very standard canonical new Keynesian model, if you want. Unlike the standard new Keynesian model, though, I'm going to assume that the classical dichotomy holds. That is, I'm not going to deal with nominal rigidities. Why not? I will conjecture here that dealing with nominal rigidities would actually make very little difference for what I'm doing, what I'll be doing for the rest of this talk. And I'll defend that conjecture at points during the talk. And so I will do the simpler case of what if there's a classical dichotomy holds. If the classical dichotomy holds in this economy, output is proportional to productivity. If output is proportional to productivity, then any exogenous process for technology translates one-to-one to exogenous process for output. And so this is what I'm going to assume about productivity. Productivity is going to be such that the growth rate of output, or productivity, has an expected growth rate g, and is subject to normal shocks with some variance sigma y. That growth rate in turn, this would be standard technology shocks in the words of the literature. In turn, I forgot a d here, sorry. In turn, the growth rate is also a stochastic process that follows an AR1. It converges to a long-run mean G bar, where kappa is the speed of mean reversion, and it suffers some shock sigma G. In the literature, we'd call these news shocks about the future growth rate of productivity in the macro literature. Well, in this very simple economy, because of the classical economy, I can right away tell you what the real equilibrium is without speaking about monetary policy, and it is simply that the real interest rate follows likewise an AR1, or not aggressive or stationary process, where the average real interest rate follows the Ramsey formula. The higher is growth, the higher is real interest rates. The more patient people are, the higher are interest rates. But on top of it, and this is the virtue of this continuous time formulation, we have the precautionary saving effect that more uncertainty leads people to want to save more and therefore lower interest rates in this very tractable linear way. Let me talk then about monetary policy in the central bank. The central bank takes on deposits, reserves, but these can be of some arbitrary maturity S. They promise an interest rate on those reserves. How do those reserves get priced in the market? Well, if M is the marginal utility of consumption, they get priced through a standard Euler equation. In the limit where reserves are instantaneous, then the Euler equation becomes this. Now, I'm going to assume that the central bank is independent and that rebates any gains or losses from reserves at 6, 12 months, or whatever arbitrary maturity entirely to the fiscal authority, which means that by a theorem that I proved with Bob Hall some years ago, that's all we need to talk about in terms of fiscal policy. The central bank is always solvent. The more interesting then, one can focus is on the feedback rule, the rule for interest rates. And here I'm going to do something extremely conventional. I'm writing it here in terms of the overnight rate. Again, in the paper, or in the presentation, I'll then be telling you about longer rates. But let me start with a conventional case. If inflation is above a target, the central bank raises interest rates, where phi is the coefficient that increases them. If inflation is on target, though, interest rates stay equal to some intercept, if you want, some xt. What is this xt? It's a mix of what the central bank estimates to be the natural rate of interest. It's a mix of that, 1. 2, of what its inflation target is. And 3, likewise, of what the flexible inflation target is. In particular, this xt absorbs the standard output gap terms that one would have in the Taylor rule. On top of that, the central bank smooths interest rates. Rho is nothing but the lagged interest rate that is the interest rate smoothing coefficient that appears. Okay? Importantly, x, which again combines changes in the flexible inflation targets, changes in output, changes in estimates of where the natural rate of interest will be, are going to likewise be stochastic and have some long-run mean. What's then the nominal equilibrium? I've already pinned down real things, so all I need to pin down is inflation. So what is the inflation? Well, I'm going to specialize from rational expectation equilibrium to this fancy word, bounded homoscedastic Markov. So let me tell you what that means. I'm going to solve for equilibrium in which inflation is a Markov process, and in particular diffusion. I conjecture and actually even show in the appendix of the paper that if I allow for sunspots, it wouldn't change. There are no sunspots in this economy under the rules that I'll consider. So that's actually not a big thing, but allows me to simplify the algebra going through. What do I mean by homoscedastic? Well, inflation, there's expected inflation pi bar that depends on the state of the economy. And then there's also the variance of inflation, if you want the responsiveness to all the shocks I've introduced so far. Now, here, I'm going to assume that these responsiveness are constant, thus the homoscedastic. Again, in the paper I show later, but it's easier to do the proofs without it, that this is also no restriction at all. Essentially, because this is homoscedastic real shocks, there's also going to be homoscedastic inflation. The really important assumption here is the bounded assumption. And the boundedness assumption is the assumption that any path that involves inflation, expected inflation in any way exploding, that is for any epsilon positive, the inflation path has to converge to 0, is going to be ruled out. Now this is the assumption that the entire literature on Taylor rules does. It is an assumption that all the way back to the 1980s, the work of Oswald and Rogoff has been highlighted as being not the most solid. There's no micro foundation for this assumption. It's an assumption on a nominal outcome. It's not a transversality condition, even though it may resemble it. And it's the one that John Cochrane in the last few years has been putting an enormous amount of attention on and saying, I want to get rid of this and replace it to all kinds of different crazy ideas that he has. Crazy in a good sense, original ideas, to then come up with different outcomes. But I'm going to stay here within the conventional of focusing on these so-called bounded equilibrium. Okay? Now, having defined equilibrium this way, let me just tell you briefly on how the maths will work. Essentially, what you can do is you can combine the Euler equation to derive a Fisher condition. You combine that within the Taylor rule, and what you derive is actually a very simple ordinary differential equation for an adjusted expected inflation. The first result is that as long as phi is bigger than rho, then there's a unique solution. What's phi bigger than rho? The Taylor condition. You may be used to seeing something bigger than 1, because continuous time is bigger than 0. This is the interest rate adjustment coefficient. But if that's the case, essentially what the Taylor principle does is it violates the boundedness condition for any path that is not just this unique one. And again, this has been the source of debate in the last few years. Second result is that inflation deviates from target according to these epsilons. And so what are these epsilons? These epsilons are equal to this. This expression, remember, this is the real interest rate, expected inflation, this is the inflation risk premium, and this is the nominal interest rate that's set. A central bank in a world that has uncertainty, that has risk premium, doesn't need to just track what's happening to the natural interest rate or what's happening to its inflation target. It also needs to keep track of what the inflation premium is. If these move around, that is, if the central bank is neither omniscient in that it knows all these fundamentals, is neither long-lived enough to understand that it may change its mind or pine star, and again, if it cares about real activity, it will have a lot of difficulty setting epsilon to 0 at all dates, or it may even not want to do so, and in such a case, inflation will deviate from target. Considering the extreme case where instead of having x mimic exactly what's happening to all of these other endogenous variables, x is just an exogenous process, again AR1. In that case, expected inflation deviates from target, not just according to first an intercept. Again, the fact that the central bank will get wrong what's happening to inflation risk premium, will get wrong at what level the real interest rate is, as recent changes to the real interest rate have highlighted in a substantial way in the last few years, but also that any shocks to either, if you want, monetary policy X or the real economy or productivity R lead to changes in expected inflation. Now, this is the deviation of expected inflation, but as are more interesting is, of course, the deviation is of actual inflation. Remember, these are my alpha coefficients. And here you see that higher nominal rates, a positive shock to X, always and unambiguously lowers inflation. It's contractionary policy, even if higher X then, looking forward, can either raise or lower expected inflation, depending essentially on how persistent the shock to inflation is. This is again the confusion that has unfortunately arisen and is even outside of the internet on the so-called neo-Fisherity effects, is that a very short-lived increase in interest rates lowers inflation, but a permanent increase in short-term interest rates is just an increase in the inflation target and obviously raises interest rates. It's the difference between the impact versus the expected, something that we should have understood, but for some reason, much too much ink has been lost on this in the last couple of years. Second note that shocks to output that in this economy, remember I separate shocks to output from shocks to the growth rate of output. Shocks to output have no effect on inflation. Why? They don't move any real interest rate. It's the same argument for why sudden spot shocks and my argument on how musculasticity comes. Now the payoff of doing this work comes really in this slide, which is that now that I have solved for inflation endogenously, and inflation, remember, is this essentially Ito process, and given that real interest rates were also Ito processes, I can now solve for the nominal interest rate very easily. And the nominal interest rate is going to fall into the class, for those of you who've done some finance, of affine term structures of the yield curve. And as a result, I can very easily read off what is going to be the yield curve. There's the yield on a bond of maturity S. Or in this case, I shouldn't say bond, of reserves of the central bank of maturity S, the purpose of the study. These expressions, delta X and delta 0, are sometimes somewhat complex. Well, they're very easy numerically to solve. But the delta I, that is how much does the long-term rate depend on the short-term rate, is given by this relatively simple expression. This is why, again, I stay within this affine class. The important thing to note is that if S is very low, as you'd expect, delta 0 and delta X go to 0, and delta I goes to 1. It better be so, right? Because IT is nothing but the limit of ITS as S goes to 0. Okay? However, and that must be so insofar as there's an arbitrage relation. If the central bank set the interest on reserves, IS, in a way that did not satisfy this equation, then you'd have either infinite reserves or zero reserves at the central bank, and enormous pressure towards not having an equilibrium, or at least going to a constraint. For large maturities, though, when S is large, delta I gets very small. Right away, we get an evaluation of what could go wrong if a central bank chooses, say, the 10-year rate as opposed to the overnight rate. Any movement, that 10-year rate, I would assume, would work, the setting of it would be similar to the way we set short-term rates now. That is, every so many weeks, raise or lower by 25 basis points. Well, a few days before the Central Bank of Chile or the ECB or the Fed sits to meet and discuss whether to raise, say, the 5-year rate or even the 1-year rate by 25 basis points, the markets will realize that this 25 basis point potential change in the 1-year rate, say, has, because delta I is, let's say, 0.5, has an impact, or even better, 0.1, which is actually pretty realistic, would have an impact of 250 basis points on the overnight rate. We'd have enormous speculation on the overnight interest rate 3 days before the Bank of England, say, MPC meets, which I would argue potentially could lead to severe concerns in implementing a policy of this type. Last thing I'll say in the model for turning to my loved historical episodes is to say that once you've done this work, and I've done it in the simplest Vasicek type model of affine class of interest rates, if you don't know what it is, what I just meant, forget it, it doesn't mean much. This is all to say that within the affine structure, you can there's a rich set of models you can connect to data, include effective QE and many others. But let me turn now to the history that I wanted to do. There's an enormous amount of work on the United States during the Great Depression, and especially the criticisms that Friedman and Schwartz so much emphasize. Turns out that also the way in which we describe the Fed today is really the Fed post-1951, post the so-called Treasury-Fed Accord, which I'll mention soon. Between 1942 and 51, there's a much, much thinner literature on what the Fed was doing, so let me tell you what it was doing. The goal of monetary policy in this period was, as always for every developed country during the war, was to essentially keep bond prices low so that the Treasury can sell bonds and finance the war effort. The policy regime, and the one that has taken a little bit of attention, especially Milton Friedman, was that it announced that the overnight rate was not, the federal funds rate was not the goal of policy in this period. It was the 90-day Treasury bill rate at a fixed peg of 0.3%. People have noted this and had said, this is a time in which, if you want, the Sargent and Wallace famous indeterminacy took over, insofar as by pegging the interest rate, inflation went out of control. Unfortunately, that's actually not a good description of all of this period. One, inflation didn't go out of control at all. And two, the so-called peg on interest rates lasted for less than 5 years. As soon as inflation actually changed a little, the Fed lobbied Treasury, got in a fight with it, and raised interest rates, in this case, the rate on the T-bill rate. We've been longer at unchanged interest rates in the US now, much longer than we did during this period of supposed peg on short-term interest rates. Indeed, when we got to 1949, or the beginning of 1950 and the end of the Korean War, there was a very large shock to the real interest rate through the anticipation of large fiscal deficits going forward. The Fed right away said, we cannot in any way keep on supporting bond policy through this peg on interest rate. And the famous Accord of 1951, which Friedman and Schwartz argue was one of the most important episodes, if not the most, of American monetary history, at least in the attention it got, set what we now call the modern Fed and the so-called dual mandate, where the Fed broke free from the Treasury in the sense of no longer committing to the 90-day T-bill rate. There's another side of this regime, though, which is the one that has been virtually, well, not very studied so far, aside from some economic historians. Which is 1942 was not just a target for the 90-day T-bill rate. As importantly, I would argue, was the fact that the Fed explicitly announced a ceiling of 2.5% for the 10-year rate. For the first few years, this didn't bind. Rates were well below it. But between 45 and 47, as I describe in the paper, actually interest rates went up a little bit as the war was ending. And as they did, they reached 2.37% in November of 1947, and the Fed worried and said, and as the Fed worried, why? Because when you're keeping a peg on the T-bill rate and you have the ceiling, you're not keeping a peg. As you have a ceiling on the long-term rate and short-term rates were increasing, as I told you, the T-bill rate was rising 47, 48, what happened was that banks very quickly said, well, why don't you then, I don't want your long-term bonds, so you buy them at the ceiling. And so what you saw was the first modern QE version in the Fed's history where the Fed's balance sheet expanded and went longer because it had a ceiling on the long-term rate. Now, even then, though, the Fed was committed to its target. Friedman and Schwartz, and again, a not very studied part of the monetary history of the United States, make the observation that few have disputed, that this was because the ceiling was not, unlike the peg on the T-bill rate, the ceiling was actually supported by the Fed. Intellectually, the idea of putting a ceiling had actually emerged from Fed economists in the 1930s and 40s. And so even as the Fed Treasury, it was saying, in no way will I keep on pegging the T-bill rate, the result at the same time assuring that absolutely we'll keep the ceiling on the long-term rates. Even after the Korean War and after the Treasury-Fed Accord of 1951, the ceiling stays. It only gets abandoned in 1953, and it's only at the stage that the Fed goes back on QE, in a situation that lasted for 56 years, and says, from now on, we'll deal with bills only and no bonds, because our balance sheet, we felt that we lost control of our balance sheet and its maturity for a while. Let me try to make sense of this within my model of what was going on, or do an evaluation. Let me start just with a simple case, which is what if indeed you had a peg? Well, then what you have is that the Fisher equation, that is expected inflation, is equal to nominal interest rates minus real interest rates plus inflation risk premium. In terms of my graphs, this becomes a Fisher equation, and the policy rule is to set x to some fixed amount, x bar, say. This is a phase diagram that shows you that essentially you always move along the Fisher equation, that's a no arbitrage condition, but if you're above the brown line, the policy rule, inflation falls. If you're below it, it increases. You get here the indeterminacy result that with a peg, essentially any existing combination of inflation and volatility inflation alpha, i.e. a different point in this red line, are consistent with equilibrium because they all just converge to the target. If instead, though, one has a Taylor rule, and this is again, it should be a somewhat familiar plot, although here written in the nice phase diagram way that continuous time allows you to do, you have that because the policy rule, the Taylor rule coefficient condition is essentially the policy rule, the brown line is steeper than the red line, you end up, this becomes a saddle path equilibrium, that is, any deviation of inflation from target leads to an explosion, which then gets ruled out by the boundedness condition. Well, what happens if we have a ceiling? Very hard to do, it turns out, in discrete time, continuous time, extremely elegant to do and easy to do because of my very powerful affine proposition. Well, if you have a ceiling, essentially what happens is that you have the Taylor rule principle applying, but once interest rates gets too high, the short-term interest rate, you get a ceiling in the long-term interest rate, making essentially what's similar to a peg. But now what you have is that any small deviation of inflation, the Fed can react with changes in X. Any negative deviations are ruled out by equilibrium. But now you have the danger, is that on top of the low inflation equilibrium, you have not an explosion, but rather a convergence to a high inflation equilibrium as a virtue of the fact that you can't raise interest rates without breaking your peg. As a result, when the Korean War comes, the Fisher equation shifts because of an increase in real interest rates. The Fed finds that it will likely be in this path that goes towards H as it tries to adjust its policy rate and finds the constraint. And so it becomes likely in 1951-52 that it was starting to get into this H equilibrium, and as a result, it lets go of the peg, the ceiling, and tries to get back into the swirl to make sure that the L equilibrium is restored. So, pegs on long-term interest rates, dangerous. Dangerous why? Because they ultimately create a new high inflation equilibrium to which the economy may converge if it gets hit by a bad shock and the Fed is not quick enough to respond. Second episode of monetary history, one on which much more has been written, although somewhat different from the perspective I'll take. The so-called Radcliffe Commission in the UK. So let me give you some background on that. So the Radcliffe Report is a very famous report in monetary history. To give you an idea, it was published in 1959. It was headed by this Lord Radcliffe, and it had the unbelievably, from today's perspective, ambitious goal of essentially understanding what is monetary policy and what do central banks do. To give you again a sense of its influence, in 1960 there was a special lead articles in the Review of Economic Statistics, the Journal of Finance, and, I forget the third one, maybe the American Economic Review, I think, all on just what Radcliffe means for what we understand about monetary economics. Okay. So at the time, actually, the three top journals. Econometrics was still going on up, and the QG wasn't doing very well. Let me describe how we got there, briefly. Again, in the 1950s, the UK monetary policy was very much influenced by Keynesian ideas on keeping unemployment low. However, the policy tool to keep unemployment low was fiscal policy, and the apparatus was Keynesian aggregate demand management. What was the role of monetary policy? Essentially manage international reserves, set the overnight rate to make sure that the currency doesn't fluctuate too much. This led to very strong criticisms from the Keynesian camp to the Bank of England, because at the same time, Keynesian theory talked about how important it was to lower long-term interest rates, so it's called the cheap money policies, and in doing so, promote investment. The Bank of England was seen as this short-sighted institution that all it did was focus on short-term interest rates because it was still holding on to the gold standard period. At the same time, there was likewise a ceiling or a target of the 2.5% rate, and what that implied is that, but it was implemented very different in England by the Treasury. Essentially, the Treasury would announce, I will sell bonds at 2.5%. If people said, no, I don't want to hold them, the price has to change, the Treasury would say, okay, then I won't sell you any. I'll sell you 5-year bonds at 2.5%. You don't want them? 2-year bonds. Eventually, someone would want them as the maturity. Since the maturity was the endogenous variable and the prices were the fixed variable. Now, the intellectual debate that comes on monetary policy here, which I'm going to try to stretch my time a little bit, was very interesting, and the Radcliffe Report is very interesting on that account. For one, money, or the link between money and prices, was rejected in the Radcliffe Report, as was convention at the time. Anna Schwartz, for decades and decades afterwards, referred to the Radcliffe Report essentially as the biggest crime on monetary theory ever. Because instead, this person, Paish, who was actually a very prominent economist back in the 50s and 60s at the London School of Economics, said that it's not money that matters, it's liquidity. And liquidity was this very vaguely defined concept that had to do with the condition of financial markets. Which actually, I mean, some of the more recent bad work on the return of credit and liquidity should do well to go and read back with Paish and the mistakes that we now know that he made. Much more influential was Lyle Robbins, also at the London School of Economics, who had argued that the Bank of England should mostly do credit policies. And so again, for many in this room and in this conference, as we're going to be talking about credit policy and macroprudential, that was the dominant view back then in England. That throughout the 50s, the Bank of England did mostly what today we'd call macroprudential policy in an incredibly activist way. There was a third influential view, though, associated with Frank Hand, the general equilibrium theorist from Cambridge, which essentially, based very much on general equilibrium, said there's a right level of interest rates. And the job of a central bank, in part, is to simply make sure that the right level emerges. And that's the right level for the 5-year rate, for the 10-year rate, and for the overnight rate. The Bank of England, the Ratcliffe report had many of the, I've already discussed these, but especially it completely embraces this hand view. The Bank of England must have and must consciously exercise a positive policy about interest rates, long as well as short, and about the relationship between them. Combined with this was the fact that setting interest rate, again, this view that came from before, from the National Debt Commission in the 40s, that you set interest rates, let quantities adjust, and moreover, the view that interest rates have little to do with aggregate demand or money, and so they can just be targeted to achieving what you want in the Treasury market. The Bank of England during the 50s adopted the Ratcliffe report, during the 60s, adopted the Ratcliffe report, and as a result set the short rate stabilized exchange rate, while at the same time trying to estimate the right level for long-term interest rates and using all these big credit policies in order to achieve a steady demand for bonds at the interest rates that had been set. Let me try to make sense of this in my framework. Simple application is to say, well, they were pegging long-term interest rates around an exogenous iota, an exogenous target. If so, you get a similar analysis of indeterminacy as before. I could go through it, but it's not different from the hard peg I discussed before. Let me discuss, though, somewhat of an alternative, which at least is not rejected in data. I won't say it's a representative of the data, which is, you could say that the Bank of England essentially was using long-term interest rates as the tool for monetary policy. And so let me write a Taylor rule, but written in terms of the long-term interest rate instead of the short-term interest rate. Again, discrete times is very hard to solve. In continuous time, it's extremely easy. This maps exactly into my results on phi and alpha that I showed you a long time ago. The same alpha, the same expected inflation. But now these link to the new policy according to these expressions. On the first, if S is small, that is, therefore delta S is very close to 1, then essentially we have the same result as before, as you should. However, going long is trying to, again, use the 5-year rate as your instrument of monetary policy. If you do so, delta S is very small. Delta S is very small. It means that the central bank has to respond if delta S is very small, for a given phi, let's say bigger than rho, the determinacy condition, the central bank has to respond very little in its long-term interest rates to inflation. Actually, the Taylor condition doesn't hold in the sense of the bigger than 1 that you've learned to love and admire. That's true for the overnight rate. If you did it for the 5-year rate, the Taylor condition would be not bigger than 1, but bigger than 0.05 or whatnot. The second result is that, remember, keeping x close to this mythical epsilon, to keep epsilon to 0, would be important in order to keep inflation under control. But now note that a central bank that targets the 5-year rate has to know not just the same things as before, everything that went to the epsilon, that is, in setting iota, it needs to know not just all the things that went into the x, but also needs to know delta 0, delta I, and delta x. That is, it needs to know not just where the yield curve is, but the sensitivity of the yield curve to every single shock in the economy. Remember, before I need to know the real interest rate, how to respond to shocks, I need to know expected inflation and the output gap, how to respond to shocks. I need to know the inflation risk premium, how to respond to shocks. On top of that, now I need to know where the yield curve is and how we will respond in respect to every shock in the economy. Essentially, the 5-year rate is contaminated by all these yield curve movements, all these yield curve movements. And as a result, the likelihood that there will be shocks to inflation coming from financial disruptions is much larger. Okay? So, I guess I already talked about this. The UK in the 60s struggled, interest rates crept up, inflation rose. Not again because of an indeterminacy, but more that inflation, somewhat consistent with what I was telling you before, central bank had a lot of difficulty adjusting interest rates to keep track of the inflation, and thus ended up with very volatile inflation. And this led into the 1970s to the rise of monetarism with Charles Goodhart and his influence at the Bank of England. Third historical case, not so much historical, it's only 12 months old. The Bank of Japan. The Bank of Japan, this I can rush through in my 1 minute and 51 seconds, has struggled with inflation below target for now 20 years. Inflation has only exceeded 2% since 1985 twice. As a result, it has lowered nominal interest rates, starting from the late 90s, and pursued forward guidance, together with quantitative easing, expanding its balance sheet and buying a series of different assets. 12 months ago, though, the Bank of Japan announced a new policy, yield curve control. What is that? Not only it announced that its policy rate is minus 0.1%, negative as in Frank's paper in the ECB, but also it announces that it wants the 10-year rate to be around 0%. How does it do so? It does so essentially by intervening in the market at 10-year rates, buying and selling, i.e. open market operations, and has even ran some auctions of 10-year deposits and 10-year loans in order to do the same ceilings and floors that one does at the overnight rate. Now, for a central bank that targets two rates independently, in principle that can lead to trouble. That means pinning down a relative price, something that a central bank can't do, or at least Milton Friedman warned us it shouldn't be able to do. Whether that's correct or not, I have some other work questioning whether actually you can pin down different points in the yield curve. But for now, let me accept that case, just in the sense that if indeed the 10-year rate was inconsistent with the expected path for the next 10 years of the 0-year rate, we should have expected a large movement in the 10-year deposits versus the 0-year deposits in the Bank of Japan, which we didn't. So I'm going to interpret their policy somewhat differently. Not as two targets, or as two targets, but, and this is actually very consistent with Governor Kuroda's speeches, which is that essentially the BOJ has now set this as being minus 0.1 and the 0, and when it raises short-term rates, it will raise long-term rates with them. That is, that what it's targeting is a short-term rate and, if you want, the slope of the yield curve. That it's wanting to flatten the yield curve, that it's the steepness of the yield curve that will respond. How will I map this into my model? This BOJ, let me write it, is essentially following, let's say, the same Taylor principle as it should, but now targeting the yield curve slope. Iota now, its target, is for the gap between the 10-year rate and the overnight rate. Well, if it follows this rule, again, it's actually very easy to prove this after you've suffered through the first 10 minutes of this talk. Turns out that you get exactly the same inflation outcome, but now the map from this policy rule into the phi's is this one. And here's the main thing I want to tell you, which is that, remember, phi I is very small. Phi I minus 1, therefore, is negative. Therefore, for me to have determinacy phi positive, I need phi iota to be negative. When inflation rises, what I want to do is to flatten the yield curve. When inflation falls, I want to steepen the yield curve. Why is that? That is, the BOJ should commit to increasing the 10-year yield by less than the overnight rate when inflation increases. Why is that? Because in this basic monetary equilibrium model, but this is the basic model that is at the heart of all the DSGs that we write, stimulating inflation involves indeed cutting the short-term rate, but it's cutting the short-term rate while keeping in change the long-term rate. It's a temporary cut in the short-term rate. That is, it's the steepening of the yield curve that stimulates inflation. Central banks in the last few years have been flattening the yield curve to stimulate inflation. At least the basic monetary theory says that it's the other way around. Of course, and here's something that comes up, is that, of course, changing 10-year rates may affect investment, real activity, and through the slope of the Phillips curve stimulate inflation, which I think certainly when one reads speeches is what central banks seem to have in mind. But it's important now to keep this other monetary effect in mind. Performance so far, not very good. But then again, the BOJ has said that phi iota is positive when the theory says it should be negative. To conclude, in my minus 3 minutes, I think, or 2 minutes and a half, I try to tell you three things. First, that in the past decade, central banks went long. Why do I mean by that? The long-term interest rate appears in speeches now all the time. It becomes, in some countries, like the Bank of Japan, it became the explicit instrument or target even. I try to think about this and what this means before we go down the path of making the long-term interest rate have an even bigger role than it has now. Now it's, I think, just a very prominent indicator. I noted that, one, this comes with a lot of volatility in short-term markets. Two, that historical case studies of each time we did so when we went very long, none of them were really very successful in ways that I think the theory highlighted. And methodologically, I try to show you how one can do the study by linking monetary policy to yield curve by using this approach. Thank you.